So, welcome back to our webinar series, Learn to Trade the Market. Yeah, with my name, Stefan Friedrichowski, as always, and always at the same time. That means 2 o'clock in Germany. And today we have the 10th of January. 2017, by the way, but that is now already 10 days old. So we get used to that year, and that's good. And we can proceed our learnings about trading the markets. Yeah, as always, you find already the slides for today in your download folder of your GoToWebinar control panel. So you are able to get those slides, and that means immediately, so you have all those links like previous webinars here on my first slide. You can look to those recordings of our webinars on that YouTube channel mentioned here on that first slide. The link is quite complicated, but with a PDF document, it should be easy for you to follow that link. Here, topics for today. As always, we will shortly recap what we have done last week, and then we can go on further. And that means that today I want to introduce 2 useful indicators for trading. You might know that MT4 has a possibility to drag and drop indicators on the chart, and I will introduce 2 which I personally find quite useful for my trading activities. Then we go further into learning to trade the market by a selection of what I call good underlyings or good symbols which behave fine, which have a good relation between costs of trading and spreads and so on. And out of that, out of those good underlyings, we can set up a portfolio for our trading activities. Finally, what we will do is we want to set up so-called profiles in MT4, our trading platform of choice, and those profiles help us to be, let's say, fast and to get our trading decisions right well, and don't have to do that much with all the techniques, all the charts, because we can standardize all those activities, and that help us to find the good trades a little bit faster. Finally, I want to show some trading praxis with 2 basic setups, and want to introduce those setups, and then I want to practice those setups with you together in MT4 and look what kind of trades we can do in the markets. But first of all, a short recap. And the short recap starts with our account in MT4. And last week we set up 1 trade, and you still can see that trade was a minus trade, so it was a loser. Of course, those things happen, and you will realize those minus trades, winner trades, yeah, they will change, they will iterate. Let's see what we can do finally. By the way, funny enough, as you might know, I do that webinar twice on Tuesday, 1 in English and 1 in German. And during the German session later in the afternoon or early evening, I did more or less the same trade, and that trade, I can show you, is still up and running. Same idea. Different point in time of execution, and yeah, that trade is still running, is up to now a positive trade. Let's see how far that trade will go. But that's not for today. I keep those activities separate. That means I have to live with the first trade we have done in this account, and we go on in that account further. So what we did last week, we introduced the difference between ask and bid prices, so you know what kind of price you have with a long trade, what kind of price you have with a short trade. If you open a short trade, if you close a short trade, if you open a long trade, if you close a long trade, there's always a difference. And we went through that topic. And bottom line, or the rule of thumb, or what you can remember is still the one sentence: the spread, so the difference between ask and bid, is always against you. So if you don't know exactly what was asked, what was bid, and if I open a long trade, just think about it should be against you, and you find the right sequence of ask and bid for a long and ask and bid for a short trade. What we did else is we introduced the concept of risk-reward ratio. So that is the quotient, the ratio of the potential win of trade divided by the potential loss, or the desired or allowed minus of the trade, so the distance to the stop loss. And we realized that it's better to have risk-reward ratios above 1, or even more in the range of 2 up to 4, in order to be, let's call it, a little bit more on the safe side. Not really, there's no safe side in trading activities, but finally we realized if we have, for example, a risk-reward ratio of 1, then we need a win rate of 50% in order to have a break-even account. So in other words, if we move our risk-reward ratio to higher numbers, greater than 1, then we can live with smaller win rates below 50%, and that is the right way, at least for beginners. And we act here as beginners, and therefore this is my personal recommendation. So that have been the topics of the last week. And by the way, thanks to Argo-Trading that they make that webinar series possible. And of course, the other sentence you hear always within that webinar, that is the so-called risk disclaimer here on my first slide. That means when you finally trade on your own, you do it on your own. But that is obvious that you are responsible for your own trades and nobody else. Good. So I want to introduce 2 indicators today. Indicators in MT4, and we will set up those indicators, of course, in our MT4 platform, in our trades. And but before I start with those indicators, let me make some general remarks about indicators at all. So indicators are a quite helpful tool for trading activities, but nothing more. Because formally indicators, and you can turn whatever indicator you know, you can turn every indicator more like a mathematical function, a formula. And that formula, what is that formula doing? It's always nothing else than mapping a certain history of price data to a more or less single number. Maybe it's not one number, but several numbers. And so finally, all those indicators are related to the history of price, and that history of price is transferred or mapped into a number. You will see that later with our 2 indicators I want to introduce, but I always remind that indicators can only help within your trading activities, but just only follow an indicator that would be the holy grail of trading, and be sure that holy grail does not exist. But nevertheless, they help us to find the right trading opportunities, and that's already good that we have some tools which help for our own trading activities. So the first indicator I want to introduce is the so-called average true range. The name is not really meaningful. We could follow the math behind and how to calculate, but let me just describe what that indicator is doing. And what that indicator is doing, it more or less measures the historical volatility. What does it mean? So you have maybe seen historical charts, and you might have seen, and we will look later into some numbers as well. For example, 2008, the climax of the financial crisis. During that period, the volatility of the market has increased dramatically. That means, for example, that a typical move within the DAX, which is normally maybe, let's say, 20 points within 1 hour. At that point in time, 2008, it was possible that already within 5 minutes you have 100 points. And that means the volatility of the market has been extremely high. So already within very short time frames, we have seen huge price movements in whatever direction. But that means if you think about a trade and you think about, hey, I want to place a stop loss for that trade, you immediately realize we should relate a potential stop loss to the volatility of the market. What does it mean? If, for example, the volatility is extremely high, so we have already within minutes, within 5 minutes, huge movements within the market, and you want to trade, then it does not make any sense to have very close and tight stop losses. So we can relate the volatility of a market to our potential stop losses of a trade. The higher the volatility, the more distance, the more distance the stop loss should have to the entry of our trade. So it's good that we have something which measures the volatility, and that indicator is called average true range. And already mentioning, there is a relationship between potential stop losses and this so-called ATR value. So good multiplier, because ATR is a number, just nothing else is a number, and good multipliers to set stop losses are in the range between 2 and 5. Let me already move to MT4 in order to introduce a little bit better this indicator. So right now here we have, and I can stick to that, euro, US dollar on an H4 time frame. And in order to have that indicator within the chart, I can take the indicator out of the list of potential indicators within the navigator. Within the navigator, you have things like the account, for example, indicators, expert advisors, and so on. But within the list of indicators, there's one which is called average true range, so this ATR. And all you have to do is you take that indicator and do a drag and drop via mouse on the chart. So you press your mouse on ATR and you release the mouse on the chart. And now there's one point. You see there's opening a dialog here, and there's one input variable, and that input variable is the so-called ATR period. The original standard value here is, for example, 14. What does it mean? This 14 only, the meaning of the value is that 14 candles are taken of the history of prices in order to calculate the average true range. So if we increase the number from 14 to, for example, 20, then we would take the last 20 candles in order to get that number. Let's first start with the value 14 here, and now you see there's a second chart within the overall chart, and that chart shows the volatility of the market. In order to have it a little bit better, because that second chart has his own axis here on the right, I always prefer to have the 0 as a baseline for that ATR chart. So I double click once again the ATR, and there's another input possibility, and that is that we can choose a fixed minimum for the ATR chart. And that fixed minimum I always set to 0. Because now you see I have always a 0 here in that chart, and I don't care too much about the actual scaling of the chart. So what does the indicator now tell me? The indicator tells me that within that time period, the volatility was higher than currently. So think about our last trade. So we opened our trade within the period of higher volatility. That, already mentioned, should imply that we maybe put our stop loss a little bit further away than we do normally. But finally, we have two possibilities to set a stop loss. We can set our stop loss based on ATR values, or we can set our stop loss based on chart values. Chart values we took last week for our trade, and the chart value we have chosen for our trade was exactly here, that minimum, so this red line. So that was a stop loss based on the chart itself. Our trade has reached our stop loss, no question, but the other possibility is always to have a stop loss based on ATR values. But now back to the history, so the period. So let's first, just that you know how I do or how I derive those kind of numbers. Let me switch here to an H1 chart, because it's a little bit simpler to do the math. So H1 chart means one candle represents 1 hour. And for example, if we now switch our period for the ATR calculation to 24, that would mean that we have exactly 1 day of history within that kind of calculation. So my personal recommendation is to have two ways of how to set up that period. One is do something like a typical period and then think about of double that. That means, for example, H1 has 24 hours, that is 1 day. So my preference then would be 48. So just double that value. Or, for example, if we go for a D1 chart, then 1 month has about 22 trading days. So it would be 44. But anyhow, there is no big difference between 48 and 44. You might even not see the complete difference, so there's no big change. Finally, what I want to tell you here, if you don't go with your ATR period below in the order of 15, then the actual value of that period is not that important. you can change the period, but you will realize that there are not that big differences. Another way to find a good period is that you look on what is the potential trade duration. So what do you intend with that trade you want to enter? If you, for example, want to trade on a D1 base, then you might think about a trade, it should last maybe 20 days. So then a good estimate for that period for the ATR value would be in the order of 20 or even a little bit higher. So anyhow, just having numbers in the order of 40, 50 are good values because they represent maybe double the time of a potential trade duration in the chart, and they represent a typical time period of the chosen time frame. So D1 trade duration maybe one month. So then you balance a little bit what the ATR should measure. So now we have here a good situation, and you see that during the last 1.5 months, the volatility of the market has slightly increased. Let me quickly zoom out here a little bit, that we can see a little bit more the history of the volatility. And now I have a period here of about 4 years backwards, and you can see that there was a long time period of low volatility. Then during the end of 2015, the volatility has increased, then decreased up to 2 months ago, and from that onwards the volatility has increased once again. By the way, what are typical inputs to change the volatility? The more often we have big news events like federal interest rates decision, elections like Trump or the election within the United States, and if we have some surprising results within those news, that always increases the volatility. So that is the reason for the increase within the last 2 months, for example. But to interpret it that way doesn't really help us, but we can measure the actual volatility, and that is the purpose of that indicator. So that's the first indicator we will use. And the other indicator we will use is the one, sorry, just a second. So now we are back to my slides. So that is ATR we have already introduced. And the other one I personally find quite useful is the so-called moving average. And there are two kinds of those. By the way, there are some more, but typically you talk about EMA and SMA. And the difference, by the way, is simply the way how to calculate. The easiest and maybe simplest way of how to calculate a moving average is the so-called SMA, the simple moving average, which is quite easy to describe. If you, for example, have an EMA period, also that indicator has a period of 20, it only means take the average of the last 20 candles. And typically you use the close values of those candles, but in principle you can change even that. So you can apply the indicator to highs, to lows, to opens, to close values of candles. I will always use that indicator on close values. So if I have an SMA 20, it means take simply the average of the last 20 close prices, and that is a number you get as an EMA value for the period 20. The EMA instead is calculated a little bit differently. So let's describe it in a way that EMA moving averages, they pronounce the younger history more than the older history. So that means the exponential moving average is always a little bit more close to the actual price. So that is my preference, to have the short-term history a little bit more pronounced within the calculation of the EMA value. And by the way, that's the reason why I prefer the EMA. There are some other reasons, but finally I can tell you it's not that important whether you use EMA and SMA. There are long debates of which one is better. I don't follow those debates really, because you only have to change a little bit the period. Then in most cases they are quite close to each other. So anyhow, what does a moving average help us? So a moving average helps us to indicate trends, because it smoothes the price history. We have a better view on the overall behavior. And if I mentioned it indicates trends, it also measures the strengths of a trend. Quite simple. You only have to look to the slope, and you can do it visually, to the slope of that indicator. We will do it later in practice, to look to the slope of that indicator as one indicator of the strengths of a trend. And it helps us to realize a trend at all. So therefore, that kind of indicator helps for our trading activities. So another reason for using the moving average is that kind of indicator does represent a little bit like what I call the fair value of an underlying. You have already realized within looking to charts that sometimes we have a price which wiggles around, going up, going down, up, down, down, up, whatever. And the indicator EMA is always something like, let's call it the fair value, whatever that really means. And there is no complete definition of a fair value of an underlying, but it helps us to say, we think the EMA is the fair value. And what we can do now is we can look for strong deviations of the actual price compared to that fair value. That would be something we will finally use for a trading setup. And that trading setup, by the way, is called mean reversion strategy, which means the price tends to go back to the fair value. But that is a little bit more advanced topic, but will be within that webinar series as well. So that indicator EMA has a period, as you realized, and the simplest interpretation is just how long is the time window for that averaging process? Is it 20 candles? Is it 200 candles? And I will start here just with the number of EMA period of 200. So we more or less have the average of the last 200 candles. I want to mention already here one other use of the indicator EMA, and that is to have multiple EMAs with strongly different EMA periods, like mentioned here, 25, 50, 100, and 200. And you see already how that sequence is derived simply by doubling the value of the EMA period. And this sometimes is called more like rainbow trading. There are other names for that. That will help us later for our trading activities as well. But we will start with an EMA period of 200. So we use quite a slow changing EMA. let's look to the chart once again here. So first I will make this ATR sub chart a little bit smaller because I don't want to spend too much space for that here. But now, for whatever reason, it doesn't work. Let me. So now it works. So now I have the ATR chart a little bit smaller because that is big enough, because finally I only want to have the number. I don't need a real big chart for that. So the next is to set the EMA within our chart window. And now we have within our indicators, we have one subclass which is called trend. And if we open up this one, we have one indicator with the name moving average. And let me simply throw that one on the chart as well. And I want to change the period to 200. And now I have to choose the methodology of calculation, so the MA method. Simple means SMA, and now you see there are lots of other variants, and I will use the exponential one. And this should be applied to the close values of our candles. In principle, you see there are a lot of other values you can use for that kind of calculation. And I want to have that indicator a little bit thicker, so I change this one, and now I can press OK. And now you see the EMA in function for the chart, and you can see there the EMA follows the price with some time lag, so it's always behind the actual price change. That is the typical nature of an EMA. And just because I mentioned what is the difference between EMA and SMA, I want to share, or I want to show that a little bit here. And that's quite easy for me to do that. I take another one, I change the color. Let's do it in green. And now I switch to simple moving average and press OK. And now you see, yeah, of course, there is a difference between the two indicators, but the overall behavior is quite similar, especially within the middle part of my chart. You can really realize the calculation difference, and the difference is simply seen that the red line follows the price a little bit faster than the green line. So the EMA follows the price a little bit faster than the SMA. But let me remove the green once again, delete indicator, and now we have this indicator EMA 200 within our chart. Very good. So you will later see exactly how we use the two indicators, ATR and EMA. Both are useful in order to build your own trading decisions. But before we come once again to the trading itself, I want to create together with you what I call a portfolio for our trading activities. So you have already realized, hey, there are different underlyings we can trade. We can trade the DAX, we can trade Euro, US dollar, we can trade gold, we can trade Euro against Swedish krones, so whatever. So we have 1,000 chances of for our trades. But it's better, especially when you start trading, to concentrate on a few underlyings, so a few symbols. And that kind of selection is based now on costs of tradings, or that's one input, and the other one is I want to use different symbol classes. What does that mean? For example, we have indices. Okay, they represent stock values. Or we have commodities like oil or gold or silver or even gas or juice or whatever. So that class is called commodities. There's another commodity which is simply the forex market, and the last and final one is represented, for example, by what is called, for example, Bund future. So it's related to more or less interest rates. Yeah, let's say it that way. So what I want to do now is I want to set up a portfolio of underlyings, and within that portfolio I want to have two indices. One is the S&P 500, so the overall US market represented by the S&P 500, and another one which is simply the favorite of all German traders, the Germany 30, or the so-called DAX, and the symbol within Argus FX is called Germany 30. And by the way, S&P 500 is called SP 500. So within that portfolio, the next two underlyings for our portfolios are two commodities, and one is gold, and the other one is oil. And I will use the type Brent. There's another oil you can trade that is so-called light oil. No, sorry. Now I make a mistake. The other one is called WTI, and but anyhow, it's enough to have one within our portfolio. And then finally, we have four different forex pairs within our portfolio, and the selection is more based on those are, let's call them really majors. There is no common definition of what is a major and what is a minor forex pair, but let's use that kind of selection. And you see already we have 2 times the euro involved. We have 3 times the US dollar involved. We have 2 times the Japanese yen, and 1 time we have the British pound. The selection is motivated by the what currency has the biggest impact on the market, and the most common used forex is US dollar. Second is euro, then followed by Japanese yen and British pound. And now you realize immediately how I have set up those, or I did the selection of those 4 forex pairs. They represent the most common values of forex underlyings, and therefore I did that kind of selection. So potential extensions, if you want to do more, and if you want to consider more charts, more trading opportunities, then the next would be those in the row, and that kind of selection is more or less based on spreads, because spreads are quite important for our trading. As you have learned already, we have always to pay the spread, so the spread works against us. Therefore, I don't want to trade any exotic symbols, because those exotic symbols, they have higher spreads, and that means higher costs. So therefore, I don't recommend to trade those. So now we have 8 underlyings. They build up our portfolio, and what we have to do now is we have to set up so-called profiles in MT4 in order to have a good view on those 8 underlyings, and we will use 2 kind of ways. One is that we simply have one overall monitor with all the 8 of our trading portfolio, And then we have additional profiles for each underlying itself. And those kind of profiles we will build like we did it last week, that we have 3 different time frames within one overall picture, because that helps us to find the right trading opportunities. Let us do that step together here. So first, we need a good template. And we can start, for example, with a D1. That is fine. And let me change it a little bit to that kind of view without any chart shift. We have an ATR with a period of 44. That is fine. We have an EMA within the chart of with a period of 200. Fine. And now what we do is we store that template. Once again, templates and save template. And now the name you should use here is default, because whenever we open a new chart, it will open with the default template, and therefore that one is my choice here. And now what we want to do is let us get rid of the other charts here, which have been already within that window, and simply I delete them. Okay. And now we can first create the overall picture, so with all the 8 underlines, and that means we have to select all the appropriate symbols, and let me see which one is missing here. So we have already Euro, US dollar, that's good, and we have British pound against US dollar. That was one of our choices as well. Let me quickly go back here to the list: Euro, US dollar, Euro, Japanese yen, and the other 2. So this one is already in, this one is in, so everything is already like we intend to do. Then we have already gold, we have already Germany 30, which is DAX, and we have the S&P 500. So what is missing up to now is oil, and for oil we want to trade Brent, and now we have 8 different underlyings. Good. So now one chart is already open, that is a Euro US dollar chart. Let me quickly open for each of the other one a chart as well, so it goes quite fast. US dollar, Japanese yen, then Euro, Japanese yen, then S&P 500, then British pound against US dollar, and finally let's have a view to Brent. So now we have those 8 charts open, and in order to get those 8 charts within one overall picture, we have to press that button here, that rearranging window button, and now you see we have all the 8 within one single picture. Let's create a good sequence. That means that we have similar underlyings quite close together. Let's start with the S&P 500, and in order to get the S&P 500 being the first one, we can simply move that one here to the first. And now you have to know how the arrangement here is done. Let me repress the arrangement button. Now you see S&P 500 is the first one here, and now I want to have below the S&P 500 the Germany 30, and that means it has to be the fifth in a row here. Let me recheck. Now we have it. Okay. Oh no, sorry. It just, should be the second. So now we have it. Sorry for my mistake. Now we have those two above each other. And then let's go further with gold as the next one. So we put that one here. And below gold, I want to have Brent, because that's a commodity as well. I press a rearrange button. And now we have the four symbols, the Forex symbols, starting with Euro, US dollar, and then followed by US dollar, Japanese yen, which is okay. And then Euro, Japanese yen, and then British pound against US dollar. So that gives us an overall picture. And this one I want to store. This profile I want to store, and that profile I want to save. Therefore, I pressed first File, then Profiles, and now Save As. And I give that a name. And that I call Overview. Overview. And I indicate the time frame for that as well, and that is D1. So now we have that profile, and you can see here in the bottom line of your chart that one is selected. Good. So now I want to create, and I only show it for the first examples. I want to create a Euro US dollar sub profile. And how to do that? First, I save that existing profile once again under a new name, Save As, and that will be the Euro US dollar profile with the different time frames starting at weekly, daily, and H4. And I save it, and now I can get rid of some charts. And to delete that one as well. And now I need two additional charts in order to get that right. That is one and one additional as well, because I want to have three charts. And now let me rearrange those. And what I want to do is I want to have the first one weekly, the second daily, and this one is already daily, and the third one I want to have H4. Because that kind of sequence will help me to find good trading opportunities. And to be on the safe side, I once again will save it under the same name we have already chosen, just to make sure that it's really saved. Okay. And now I want to create an additional one. First, I save it with a new name. And that one I want to name quite similar. And what I want to do is I want to name it Euro Japanese Yen. So I have to change the details here, but that's quite easy, because all I have to do now, I have to throw the values Euro Japanese Yen to each of those charts, and I'm done. So you can repeat that sequence for all 8 underlyings, because finally that means you are able to switch between those quite fast just by selecting here the right chart. So for example, if I want to go back to the overview, now I'm back to the overview. And if I want to go back to the euro Japanese yen, now I'm back to that kind of profile. So that helps us to be, let's call it, fast within MT4. That helps us to see what we want to see and in order to derive our trading decisions. I want to have one example, but first, before I do that kind of example, let me give you some principal guideline to how to come to your own trading ideas. I call it trading practice, and I have two I call base setups for our trading activities. Finally, that will result in 4 trading ideas or 4 different trading ideas. And the 2 overall classes are trend trading, so trade the trend. And the other one is, because we will see that quite often, that we have ranges within our charts, and that I call range trading. Within those 2 overall setups, we have, in both cases, 2 ways how to trade that setup. Within the trend trading, we can trade into the direction of the trend. That means we assume the trend will last, will go further. So if something goes up, it will continue going up. Or if something goes south, it might continue to go south. So that's the easiest way of finding a trade. Another one could be that we do exactly the opposite. That means, under the name counter trend, we think that trend comes to an end. That has been long enough. It's time for a correction. And that correction is always into the opposite direction. And therefore, the setup is called counter trend. The other base setup is built by ranges, and we will see those kind of ranges within our charts. And now we have once again 2 possibilities of how to trade those ranges. One is that the price sticks and will stay within the range, and the other one is that we will break out of that range. Both are 2 potential scenarios of how it might go further. You might think, okay, it's always 2 ways. That means it's always representing short and the long trade, and you're right. It's our decision of what we do, and we will find some good arguments of how finally derive our trade direction and the potential entry for that trade. Let me do it as an example. Let us start to discuss and look for Euro Japanese yen. Let's always start with the weekly behavior. And if I describe that chart, you can see there has been a long period with the strong downward trend. And by the way, that might be even better seen within the daily chart. But anyhow, we see that. Then there has been a range type of behavior in that time of period. And right now we are once again in something which more or less looks like a range. Good. So first thing. So looking to that chart, my first idea would be, okay, that was a correction of this downwards trend. So correction is completed, and now we can go once again to the south. So that's a line of argumentation. Let's look to what happens within the daily chart. And let me first, for a second, just make this one big. Now you can see exactly the use of this EMA 200. This EMA 200 indicates us this long downwards trend, and finally that trend has gone to an end, and we can see within the very end of the chart this range type of behavior. Good. So that has, let's say, completed the first analysis. Now let's look to H4. We see here that we have had in the younger history an upwards trend, and now we are in a long range. Let me visualize that long range by two lines, and one I will place, for example, here, a little bit higher. Okay, now here, and a second line which might be here, a little bit lower. And now we see the actual price right now is exactly within that range. We are more or less exactly within that range. That means if I want to trade right now Euro Japanese yen, I would not know which direction. There's no real argument for the long, no real argument for the short. But think about all of a sudden the price move upwards here. Then we have the two chances, the breakout scenario or the stay-in scenario. So the stay-in scenario means, okay, price will move here and then go back within the range. And remember, I make that smaller. Remember that the long-term trend was already down, or is still down. So there is a good argument for the south direction. So therefore, a good trading idea would be to have a trade more or less at that red line here, but into the south direction, so a short trade. And that means this is a sell limit trade. Stop loss, a good idea, could be the ATR value. So ATR is right now 0.474, and looking for the overall range, let us compare the ATR with the overall range. The overall range is 123.7 and the lower limit is 121.5. So that's a little bit more than 2 points. So the overall range in units of ATR is 4 times ATR is the range distance or the range size. So that means a good stop loss value might be the double value of the ATR. Let me put that into numbers and finally into a trade. So I want to have a potential entry at 123.711. And I want to have a stop loss in the double distance of the ATR. The ATR right now is nearly 0.5, so times 2, it means the potential stop loss is 124.711. And now we can use our Excel sheet in order to finally calculate our trade, and I need that Excel sheet, just a second. So now let me open it. So we have our Excel sheet as already introduced last time. So we need the exchange rate, which is 123.711. And our potential entry for our trade is 123.711. Stop loss value is 124.711. And now you see our trade. It would be traded with 0.06 lot and with a take profit of 127.11. First, let us draw the stop loss, the take profit value within the chart and see is it reasonable. Okay, so 120.7 would be our profit target. So here, and our stop loss for the trade would be 124, a little bit higher, 0.7. So this value, this line is a potential entry, that one is our stop loss, and finally our trade target would be here. Good. Now we can place that order. That means right click within the chart and then place exactly the trade as a new order. So it's not a market order, it's a sell limit order. So lot size would be 0.06 and the type of the trade is a pending order and the type is a sell limit order. Now we can set the numbers. Entry price is 123.711 and we have a stop loss value of 124.711 and a take profit of 120.711. Good. And now we can place the order. So the order is placed. We have a sell limit order now within the market, and we have a stop loss here and a take profit here. Good. So we have placed trade according to the fundamental logic of potential trades, the two base setups. We will go deeper into that next week and just move around through our charts and find other good trading opportunities as well. Okay, already 1 hour ago, it's over. So I hope you enjoy the webinars and I can see you back in a week. So next webinar is next Tuesday, same time, same place. Any feedbacks, by the way, if there's any questions, feedbacks, just send me an email to friedrichowski@argosmx.com and I can assure you that I will help you quite fast. Okay, that's for now. Have a good time. See you next week. Bye-bye.